Hello, good afternoon, and welcome to another episode of the Psychology of Financial Decision Making. Today, I wanted to talk again about the behavioral gap. I hit this about once, twice a year. What I mean by that is the behavior gap of people and their investor returns relative to what their actual investments did. And so just kind of wanted to walk through some of those data points with you today. So Morningstar, a pretty well-known entity that measures performance and whatnot. They have their annual Mind the Gap report, which highlights the differences between what investments earn and what investors actually receive. So the key finding, at least through 2024, I'll have another update in about 6 months, is the average investment return, 8.2% per year. The average investor return, 7%. So a behavior gap of approximately 1.2%. Where this gap typically shows up the most in the largest spaces in the sector equity funds. Smallest is in asset allocation funds, but bonds, taxable and municipal, they do show some behavioral gaps as well. So really, what's the difference? Or why is there such a difference? And volatility, as we've talked about previously, really drives trading behavior. Sector funds have higher price swings, which means more buying and selling mistakes. Allocation funds, it's a smoother ride, less temptation to trade. So what is our takeaway? I think there are three things. Number one, we cannot control market volatility. Number two, we can control how often we check and how often we trade. And then finally, less reaction equals better long-term results. If you have any questions on this or want to debrief further, please let me know.